Good morning, everyone. I'd like to call the meeting of the Board of Directors of the California Housing Finance Agency to order and ask the Secretary to call the roll, please.
Ms. Avila Frias.
Here.
Mr. Schaefer for Mr. Chang.
Here.
Ms. Gallagher. Ms. Gunn for Dr. Imbasiani.
Here.
Mr. Gunning. Mr. Hunter.
Here.
Ms. Johnson Hall.
Here.
Mr. Metcalf.
Here.
Mr. Prince.
I don't know who he is, but Preston's here.
Ms. Hoffman for Ms. Podesta.
Here.
Ms. Sotelo. Mr. Russell. Ms. Falk.
Here.
We have a quorum.
Thank you very much. Item number 3, well, after, I guess, we're item number 2 is the Executive Director comments. Ms. Boatman-Pedersen.
It's with heavy heart this morning that I report of the sudden passing of San Francisco Mayor Ed Lee. Our thoughts and prayers are with his family and the citizens of Sacramento. That was very sudden. We've been working with the city of San Francisco very closely. We know he was a proponent of affordable housing, and we're deeply saddened by that. I'd also like to note that Board Member Gallagher she was here, but I don't think she got to. Last month, House tax reform was announced package, and in that package there was the proposal to eliminate private activity bonds. This literally caught the housing community off guard, as we had been working for several years on bipartisan legislation authored by Senator Cantwell from Washington and Senator Hatch from Utah regarding the modification of the low-income housing tax credit program. Without private activity bonds, you cannot access the 4% low-income housing tax credits. Private activity bonds and 4% tax credits provide financing for about 20,000 newly developed or rehabilitated affordable housing units in California each year. Considering the package that we brought forth last year, Governor Brown had signed after several years, this was kind of the backbone of working together with some of those programs. Also, our Veterans Housing Program, ran by CalVets, is dependent on the issuance of private activity bonds, and we were scheduled to have a 2018 ballot to put an additional $1 billion in those bonds on that ballot. On December 4th and 5th, I attended a special meeting of the National Council of State Housing Agencies Executive Directors in Washington, D.C. This was a previously scheduled meeting that we have at the end of the year. However, we took the whole meeting to discuss the elimination of private activity bonds and a strategy. NCSHA's strategy to preserve the private activity bonds includes urging the housing finance agencies, their stakeholders, and all of the parties interested in private activity bonds to contact their House and Senate members, particularly the Republicans, to ensure that they are telling their conferees, especially the House Ways and Means Committee, Chairman Kevin Brady of Texas, House Speaker Paul Ryan of Wisconsin, Senate Majority Leader Mitch McConnell, and Senate Housing Finance Chairman, that the housing bonds are essential to the provisions of affordable housing and must be preserved in the final bill. Also, in the Senate's version of the tax reform bill, private activity bonds are preserved. We are all of the housing finance agencies are emphasizing the need to make sure that members understand and communicate to those leaders affordable housing and is one of the original eligible uses of private activity bonds. I believe there's a misperception of mission creep in private activity bonds, and several members had the misperception that maybe they were going for golf courses or stadiums, but when you look at the overwhelming use of private activity bonds, especially here in California, it's gone for the preservation or development of multifamily affordable housing or hospitals or education. So we believe private activity bonds should be a part of an infrastructure and generates further infrastructure improvements in the communities that surround it. NCSHA is working with the other HFAs to place articles and op-eds in local and national medias to draw attention and to the value and importance of the private activity bonds and what would be lost if they were not continued. CalHFA has an op-ed that has ran in several newspapers in the Central Valley and the Sacramento Bee, attempting to educate folks on the use of private activity bonds. NCSHA is also working with the broader Private Activity Bond Coalition to engage as many issuers and interested parties as possible, and asking that the tax bill conferees and leaders maintain the private activity bonds by highlighting specific projects and activities in their districts and the states to show the positive impact of private activity bonds. And so that's my executive director report. We also have a few retirements, but we'll postpone that until the end of the meeting to make those announcements. So thank you, Madam Chair.
Questions, Mr. Prince?
So we were talking about this before the meeting started, and it is confusing about what is happening at the federal level. And to be quite honest, I have taken people on tours, legislative staff of representatives to tax credit properties prior to tax reform proposals and post. Prior, they understood the impact, particularly of the corporate tax rate cuts on 9%. They understood what happens with the reduction of PAB and the elimination of 4%. I don't know how to say it any more gracefully, but they don't care. So, I mean, that's the sense that I get from the delegation in the South. With that, in the Central Valley, south of here. So with that said, I understand that there is a proposal to maybe resurrect at least just the 4% tax credit, so not necessarily PAB, that is gaining some steam. So I think that maybe that is the way to go. Is to I understand that that it does negatively impact California because the allocation process, we would get less 4% tax credits under this new formula than we currently do, but at least we would get something. So I just want to advocate that we at least push for the 4%, and maybe we're going to lose the private activity bonds.
And so would they change the IRS code so that you wouldn't need the private activity bonds to access the 4%?
Yeah.
That's my
Decoupling it.
understanding. Yeah.
Okay.
I'm sure that there are people at this table who understand that way better than I do, but yeah, I have been making my phone calls to our Valley representatives, at least advocating for that. I mean, we're looking at multiple AHSC applications from the Housing Authority next year, all of which are dependent upon 4% tax credits, and so it's going to be decimating the pipeline for not just my agency, but the whole Valley, I think. So yes, we need to keep advocating for 4% tax credits. But it's a scary world. I don't understand the motivations. So it wasn't really a question, it's more of a statement.
Any other comments or questions? Okay, thank you very much.
I'm sorry, one last thing. So we over here in the corner, we conspired. We wanted to take this moment at the end of the directors to acknowledge your contributions as our chair. And I think I heard you whispering to Jonathan that sometimes after retirement, you want to like actually retire. So we're sad about that, right, Jonathan? That we have really appreciated your leadership and your guidance and just want to say thank you. And I think we all should stand up and give her recognition real quick.
Thank you very much.
Thanks.
Yeah. I'll say something at the end, so. Okay, we'll move on to item number 3. The minutes of the October 12th, 2017 meeting have been distributed, and if there is there any objection to the minutes as distributed? And if none, the minutes will be deemed approved. Are there any objections? Or questions or current comments?
I understand my name shows up as the singer Prince without a first name, so. Awesome. I know. At least it wasn't a symbol, because I'm a little nervous about what that would have been. I think just adding my first name might be.
To reassure you that we typically just use last names when
Oh,
we're
I was
referring
just told,
to
I'm
the
sorry.
board members, so,
All right,
yeah.
perfect, never mind.
Any other comments? Okay, thank you. So the minutes are deemed approved. Item number 4 is discussion, recommendation, and possible action to increase the area median income for single-family program eligibility to 150% in all counties. Mr. Sue. And others.
I brought reinforcement. So, as the board knows, I've been running single family since last September, and I want to make sure that you know that part of the reason why I can do that is because I have these two people next to me. This is Cheryl Angst, and I think Cheryl has presented the board before, and this is Nick Koufasimas. Sorry. And I realized as I was preparing for this presentation that I have been acting as the director of single family programs, but actually this is my first time coming to the board to ask for anything. And I think it shows that I inherited a really good situation. And for Jonathan's benefit, I feel like a relief pitcher coming into the fourth quarter with, 2 or 3 touchdowns up. It's a good situation.
We have to tell you that Tim is known for his really bad sportsmanship. Right. You right. Go.
I don't watch sports, so anyway. So just a quick update on single family, and I think I'm going to make some connection to some of the things that Tia was talking about. Last fiscal year, we did $1.8 billion in lending. It looks like this year we're on pace to do just about the same amount. In the business plan, we have $1.5 billion. So the business model is working. And more importantly, it is a business model that is not heavily dependent on these changes that are being contemplated in DC. It is not one that is dependent on private activity volume cap and the issuance of mortgage revenue bonds. Mortgage revenue bonds is sort of a classification of private activity volume cap. It is indirectly, however, related to mortgage revenue bonds in the sense that when we do not issue mortgage revenue bonds get turned into MCCs, mortgage credit certificates. And about 40% of our lending does use an MCC from CalHFA as well. So it is an important part of our lending, and we do feel that with the possible elimination of mortgage revenue bonds, and thus the elimination of MCCs, it's possible this will create some headwinds for the program. And I feel that it's an important context to sort of to think about as we think about this resolution. And the last but not least is that I do feel that what we're presenting to the board today is also the kind of effort that kind of puts all options on the table to address the high housing costs in the state. Okay. So Resolution 1724. So in an effort to more closely align income calculations with existing housing authority law and recent statutory changes, namely SB 2, to better serve the needs of Californians and California families. There are 2 proposals here. They're not exactly related issues, but we decided to bring them to the board together. The first one is to increase our income limits to 150% AMI, area median income, for all 58 California counties. And the second one is to adopt a single household size adjustment factor of 8, regardless of the actual household size. So the 150% AMI proposal, this is the one that probably tugs people's heart a little bit more, and this is a little bit rationale, and then we can pause at the end of some of these rationales for the board to discuss. As it turns out, since the board last adopted a resolution in the early part of last year to increase our income limits to 140% of AMI, as it turns out, the affordability index for first-time home buyers in the state has dropped by about 10%. And one can sort of think of this particular resolution as a way to counteract that kind of market movement. And 2 is that we do feel that this can be a way for us to help more moderate income families. And I'll come back in a little bit to talk about how our program breaks down in terms of AMI, which is an important thing to consider as well. And and you probably would expect this, about more than half, about 55% of our production of that $1.8 billion you heard about 55% of that actually comes from 4 counties, 140% AMI counties, Riverside, San Bernardino, Sacramento, and LA. Having sort of, it's true that I'm sort of making this push that this will allow us to expand our customer base. But having said that, about last fiscal year, about 50% of our customer base is still at 100 or below 100% AMI. This is not a huge segment of our borrower base, but it is growing slightly. So the 120% plus AMI segment of our borrower base is about 20% of our conventional lending production, but the conventional production is only about a quarter to about a third of our overall production. So when viewed in an overall production mode, it's only about 6 to 7% of our overall production. So it's not a huge segment of our production, but it is growing. So one way to think about how it's growing is that when we look at our production from 2013 to now, that 120% plus AMI production segment was about 6.5. But when we look at just last fiscal year, it grew up to about 7.5. So that segment is growing, and it makes sense as growing in the sense that it is also counteracting the forces in the marketplace in terms of price appreciation. I'm going to pause there because, as I mentioned, I feel that this one probably has more thoughts from board members before I go into the next one.
Any questions or? Oh, okay.
Wow, I'm doing good. Okay. So this one is, we don't believe that increasing our income limit from 140 to 150 will generate a huge boost in production. This one, however, is more about streamlining our program and simplifying it so that lenders can look at our program and their eyes won't just roll over and decide that this is too complicated for them to deal with. We now have in our program 464 income limits because we have one income limit per. We have 8 income limits because we have up to 8 potential households, and we have 8 income limits per county. So 8 times 58 gives you 464 income limits. And this is actually our number one reason for suspenses, which leads into a longer purchase time, which if you are familiar with the single-family lending people, it's one of the big things that they care about. They oftentimes care about the speed to close a loan rather than, let's say, pure, let's say, profit margin. The certainty of closing in a brief period of time is a very important factor for that community. And sometimes, if the calculation is done so egregiously wrong, it's quite possible it could lead to a denial, and denials are obviously not a good thing because the lenders then have to hold their loans on their portfolio, which is not a good outcome for them. And at the moment, because we make these adjustments for higher income for bigger households, it does favor a larger household slightly at the expense of the smaller households. But we do think that this is one of those things in which we want to streamline our program, simplifying it so that the lenders can look at these programs and not think that, gosh, it's another program, another government program in which it's so complicated that I just don't want to spend energy and time to deal with this kind of stuff. And ironically, this one, though, it may sound like it's not the kind of stuff that can boost production. We actually think that this is, of the two, will have a bigger impact to address that headwind I talked about earlier. Those are my comments.
Any questions about this?
Quick question.
I have a
Yes,
question.
yeah, I'll start with Mr. Hunter.
So Jonathan Hunter, so my question is, is a household size calculated first and then 150% on top of that? Are they calculated separately, or are they, how does that work?
We calculate the AMI first, and we apply it to the household.
So you have the, so you have the area median income times 150%, and then that times what? I mean, in this one example you gave us, an 8-person household is 132%, but I assume it's not 132% of 150%?
So the AMI calculations that we use, which is promulgated by HCD, is based on a household of 4.
Correct.
And then we adjust from 4 using a factor up and down.
All right, so that's where I'm still trying to figure out the order of this. So you have the AMI times 132% and then 150%? I mean, I'm not clear what's being applied first and what you end up with.
So let's just say that the area median income is 100, and then we would go up to, and then 150% of AMI happens to be 150.
Correct.
Let's just say.
Okay, I got that.
Then that number comes from the 100 comes from ACD. We apply it up to 150 AMI, and then that's based on a household of 4. And in order to go up to, let's say, 8, there's a factor we apply. So then we take the 150 multiplied by that factor to get to 150 for 8.
Right, and so that's the factor that I'm trying to understand. In the written material, you have it at 132%, but 132% of what? So on page 6, or 3.
I'm sorry, 132% of the base, which is the 4-person household. So if the base is 100, then you will have 132.
But then when does the 150 come on?
The 150 comes on for us to determine the base.
So it would be factored up, Board Member Hunter. So 150% would be a family of 4, and then you would factor up to get to the higher income, so that the income would be based on a family of 8. So it's going up.
Yeah, I'd have to do the math a couple times to see what,
Did you have?
well, I guess I do see what the example for Alameda. So anyway,
Would it be helpful, I mean, do you have what the highest possible California household income might be at the 150 and the household of 8? Maybe that would be useful for the board.
That's this number here.
I think Alameda here is pretty darn close to the highest. So this would be 100 and a little bit under 180.
Did you, Ms. Huffman?
So what are the implications for a family with more than 8?
We looked at our, it's hidden in the footnote of the memo here. We looked at our history of reservations, and we only have had 9 loans since the beginning of time that actually needed to have a household size greater than 8 to qualify.
Thank you.
I have a question. So currently, there would be 8 different levels for each income, is that correct? So
Each county.
for each county, okay, depending on household size. So I don't quite understand your statement that it's more favorable for large families, because it seems to me it's more favorable. The lower size families now can earn a lot more money.
I'm sorry.
Change
Yeah.
would do what you're saying.
It
But
bene-
right now, it's more favorable for.
Oh, okay. The change makes it actually more favorable for smaller families.
Yes, yes,
Yeah.
yes.
Okay, just want to make that clear.
That's correct.
so,
Mr. Hunter?
yeah, so I don't want to spend too much time on it, but I guess the point I'm making, or the reason I have the question is, the way I do the math, I don't come up with any of these numbers that are in the sample for Alameda County. So 116,900 is not 132% of 97.4, and it's not 150% of 97.4, so I can't figure out what it is.
you see how there's two Alameda? Can you look at the second one? The second one, I think the math is correct.
Yeah, so,
I'm sorry, I spotted that too after the memo went out. If you, John, trying to second, you see how there's like two sections for Alameda? The second one?
Yeah,
If you look at the
that's right.
second one, those factors are
Almost,
correct, not the first one.
Close to being right. Yes.
Mr. Sue, how did we settle on 8?
I think that we did, as I mentioned earlier, that we did look at our data to see at what place we can accommodate all but a few of our previous reservations. And we felt that a number like 8 will accommodate, what is it, 2 or 3 standard deviation of the folks who come to us. But it could have been, let's say, 7 or 9 or 6.
And that's kind of getting to my question, and maybe maybe just a personal preference that I'm expressing here. I don't want to try to speak on behalf of the board, but as I sit here and think about income distributions in the state, if this is you've already you're knocking on the door, what's in my head? So if we start at median and then start to distance ourselves out onto the shoulders, how many standard deviations does it take us to get to 8? And I think I heard you say it was 2. Is that right?
I think it's more than 2. Yeah, it's probably closer to 3 because we're excluding 9 out
Right.
of a population of, let's see, I don't quite remember. 9 out of 27,000.
Okay. Thank you. I want to chew on that, if I may, for a moment, Madam Chair.
Are there any other questions? I think part of what's there, Ms. Gallagher.
Yeah, I'm just looking at the numbers here. So it looks like we're effectively doubling the income limit, more or less. We're looking at an Alameda example. It sounds like, to your point, the household size is probably more moving the dial than the other. So 2 questions on that. One is that's a pretty significant change in the income limits. The other change is the counties, the high-cost counties being brought into all counties. And so we're looking at like the Bay Area or something that I read that number as one thing. When you think about the rural communities, it seems like I guess it would be a different number anyway, because the AMI would be different. Wanted to understand the logic of including all counties. Is that also a program simplicity, or is it the same kind of trend on homeownership statistics?
I think it is in part program simplicity to simplifying it. But when we do the determination for high cost, it's an exercise that we do based on averages. And sometimes when we do these exercises and we say we average across and then everything that's above the average falls in one side and everything that goes below the average falls on the other side, you get actually sometimes funny results in the sense that you will get a few that are sort of you would normally think is high cost, but then they don't end up on the right side of these averages. And that was part of our motivation of departing from that. And that happens too when we do things like purchase price. When we do exercises like that on purchase price, there are times in which Alpine County comes out as high cost. And that is counterintuitive when you see that Riverside actually comes up as not high cost. So it's just a little bit of our way to address a few that kind of falls on the wrong side of that as well.
Yeah, Ms. Boatman-Patterson?
So the larger policy issue is we're in the state of California. We're a high-cost state statewide. Traditionally and historically, we have helped the low to moderate household in the homeownership space. As homeownership and affordability for homeownership goes down, how do you continue to help the low to moderate space? And if you consider the entire state of California a high-cost state, and then you look at streamlining processes and broadening the amount of people that you serve from a public policy perspective, and then you look that housing authorities have helped homeownership at 150% AMI across the state for 40 years, then you talk about aligning those policies to make sure you're helping those folks that you can help. Historically, the limitations of 120% were because of the revenue source, which was mortgage revenue bonds. We are not using mortgage revenue bonds, so we do not have that funding source limitation. So when you look at other HFAs in the nation and their income limits, I had proposed eliminating income limits altogether, but my staff shot me down because in my mind, your limitation should be the purchase price limitation, which we do have a purchase price limitation. But I think from a policy perspective, going to 150% across the board with one income limit, with one household size, streamlines the program and is consistent with homeownership programs at the local level.
Yeah. Can I follow up?
Ms. Gallagher?
Yeah, I don't have a problem necessarily in serving a broader population. I think, I just want to make sure I understood the kind of consequence of it. The question I guess to have, the sort of flip of that is there any consequence to the lower end of the spectrum in terms of focus or not? And I think that's probably the right policy thing to discuss. And you know, that's just really, I don't know, Tim, if you have a perspective on that, or is there anything that, to amplify that, or it happens anyway? Just kind of curious for your feedback on that.
I mean, I think that the natural borrower base for us is always going to be the folks, like as I mentioned, 50% of our borrowers from last fiscal year are at 100 or below their AMI. So that is always going to be our sweet spot of folks coming to us. And we don't necessarily expect that this increase to make a huge difference in terms of the overall $1.8 billion. So then I was estimating that maybe, you know, overall this could help another 100 or 150 people. The one thing that to keep in mind, in a different thread, at the risk of making this more complicated, is that this particular movement would potentially allow us to bring more borrowers into the conventional side of our business. As I mentioned, that 120 plus is coming mostly from our conventional side of the business. And the conventional side of the business, our customers actually get a better mortgage insurance product than FHA because they can cancel it after 80% LTV. And we've been trying, and I know that Tia has been encouraging us to ramp up our conventional business a little bit more than the FHA side because of benefits like that. And we're still kind of hovering around, as I mentioned, about quarter to a third of our overall production on the conventional side. So that's also another factor that's driving this.
Ms. Boatman-Patterson?
Let me just put it real simple. We are not serving the higher borrower to the exclusion of the lower borrower. So there will be no impact to the lower income borrower because we aren't serving one to the exclusion of the other. We're just broadening the base.
Okay. Mr. Metcalf?
Thank you. So I just want to discuss briefly the sort of policy ramifications of this and why I think this is an important directional move for CalHFA. And it gets to this issue of why we need to be serving higher up a little bit higher up the income distribution. And that's just to remind folks that we're still coming out in many ways of the financial crisis. Even though it feels like a long time ago, we still haven't dug our way out. And the homeownership rate in California today stands at the lowest level since World War II. And although our markets are really very nimble and moving very quickly, I think to serve folks who have good credit scores and have reasonable incomes to support mortgages, and this is not a bad thing per se, where we, from a federal perspective, a regulated bank perspective, where the populations that have really been impacted in California and really unable to move back into homeownership have been wealth-constrained populations, which CalHFA's products are exceptionally well-suited to serve. And I think what's important to note here is that the wealth-constrained prospective homeowner population is particularly aligns with some of our, I guess, I don't know, more populations that I think we really do need to figure out ways to serve. And so, just to give you some background on this, probably the populations that have really suffered. I'll give you two examples in the wake of the financial crisis. One of them, millennials, for whom the homeownership rate today in California stands at about 30%, which is down from 43% about a decade ago. And in our communities of color. So the financial crisis saw African Americans in the state of California lose half of their accumulated wealth virtually overnight, and saw with that an attendant collapse in home ownership. And so just to give you a little bit of example on that, here in Sacramento County, for most of the last half century, up to the financial crisis, African American households had a home ownership rate just a little bit under 50%. Today that rate stands at 27%. So I think these are not going to change overnight, this dynamic, but it's part of an important policy response for the state to begin to step in and provide some correction to that market failure.
Ms. Hoffman?
Tia mentioned the single income limit that has been adopted by other or state HFAs, and I was just wondering, do we know the impact of those policy changes, both in terms of the number of loans issued and the time it takes to issue a loan? And if we don't, is that possible that we could maybe get that information?
We can try.
Can you give the secretary the estimated suspensions that would go down by going to one income limit? Do you have any idea of how much of your loans that come in are suspended because they have that complicated factoring, and how many more loans do you think you would be able?
I think it would put it at about 30% of the suspensions we have are the income calculations.
Thank you.
And to Ben's point, there are things that we're doing. For example, on October 1st, we actually introduced the FHA manufactured housing program, loan product, which with basically no overlays. It looks just like our FHA loans. So we feel that products like that are meaningful to address some of these disparities that you're talking about. And on November 1st, we introduced a VA product as well. This is something we brought to the board as part of the business planning back in the early part of the year. And on February 1st, that's just a preview of what's to come. We're doing land trust, and we're doing leaseholds. We're also doing a FHA 203K simple, or FHA simple 203K. So these are all things that we're doing on the margin to try to reach out to some of these populations that I think both Eileen and Ben are talking about.
Any further questions? Okay. Somebody like to make a motion?
I'd move approval of the item.
Thank you, Mr. Schaefer. Thank you, Ms. Huffman. Will you call the roll, please?
Ms. Avila Farias?
Yes.
Mr. Schaefer?
Aye.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Hunter?
Yes.
Ms. Johnson Hall? Mr. Metcalf?
Aye.
Mr. Prince?
Yes.
Ms. Hoffman?
Yes.
Ms. Falk?
Yes.
Resolution 1724 is approved.
Thank you.
Thank you very much, Mr. Sue, and the rest of you. I'd like to move on to item 5, which is a discussion recommendation on possible action regarding enacting the agency's bond issuance and compliance monitoring policies as required by SIDLAC. Mr. Carroll.
Yeah. Good morning, Chairman Falk and board members. This resolution we put before you, ask you to consider adopting a policy that has been required by CIDLAC. Last year, CIDLAC adopted regulations that require all bond issuers to have a formal policy for issuance and compliance, which is approved by their board of directors. So pursuant to that regulation, it's actually Tony Sertich in his new role as Enterprise Risk Management Director has compiled this document, which includes it's essentially a memorialization of practices that were already in place. We have always been in compliance with CIDLAC requirements. We have a good relationship with CIDLAC, but what we have here is a compilation of issuance practices and compliance issues. In compiling this document, we consulted with both finance, asset management, as well as multifamily and legal. So in general, this policy doesn't impose new work on us. However, there is a requirement of the CIDLAC in adopting this regulation. New projects that are issued starting in 2017 have additional monitoring requirements in terms of either site visits or desk audits of tenant compliance files. So we are currently working with CIDLAC to iron out the exact details of, the number of audits required, for example. So there would be a little bit of impact on our workload based on the finalization of CIDLAC's interpretation of their regulations. But for the most part, this is a compilation of our practice as it exists today. And I would ask you to consider adopting it, and happy to answer questions.
Are there any questions from the board?
I have one.
Ms. Gallagher?
This is an area that's gotten a lot of focus just in generally in the bond community in the last couple of years, partly because the SEC has been focusing so much on continued disclosure and disclosure. And a lot of folks that I work with go through a process where the key staff have some of these bond counsel firms come in and do a formal training on disclosure issues, just as a refresher every once a year or something. And I don't know if that's something the staff has done or is considering doing.
I'd have to ask our finance director on that. Thank you.
Yeah, sure. You're right, Eileen. There's a lot of attention on this. I think it came about from the MCDC efforts. And this particular effort, though, is motivated by the requirements from CIDLAC, I think of it as an envelope of many of the existing efforts that are afoot. We have brought, I think, our disclosure policy to the board a couple times, and I've reported to the board a couple times on what we've done on MCDC. In general, what we did was that we didn't have big infractions, but we reported anyway, and that as I guess as a good outcome of that, we actually have gotten an email from SEC saying that they appreciate our report and that they would not pursue any of our footfalls, is what I called them. And we do have a very elaborate disclosure policy, and that we have put in place recently. Last week, actually, B of A just got upgraded, Bank of Tokyo got downgraded, and we have multiple sets of eyes who are looking at this on Bloomberg. We have 2 or 3 people talking about what we actually want to put into the EMA notices. There's a lot of eyes on this, more than ever. And when the Treasurer's Office has training that gets brought in, in which the Treasurer brings in, I believe, ORIC to do these trainings, we try to attend those trainings whenever we can as well.
Thank you.
Ms. Boatman? Oh, Ms. Johnson Hall?
Just wanted to mention that we internally, as a best practice, have an annual training. So it might be something that you might want to consider going forward.
And I think it's been a couple of years since we did disclosure training. I think we did it at one of our audit meetings, but it has been a couple of years, so we'll consider bringing that back and doing a disclosure training for the board.
Mr. Shaver?
Mr. Sue has referenced the training program that is used in the state treasurer's office, and I'd just like to emphasize that we're always willing to make that available to your staff, because it's portable. It's not unique to what goes on inside 915 Capitol Mall. It is a program that has received a very significant amount of vetting from the legal community and the disclosure community. It's consistent with the guidance, either direct or inferentially received from the SEC, particularly with respect to the City of San Diego matter. So I would just, I would encourage participation by staff members who would come into possession of facts that might be important to get up to you at management level, as we do in our building. And sometimes, and this is the point, it took me a little while to get to the point, sometimes my personal view is that it also helps to get managers involved, particularly those who are not involved. I'm not worried about you, okay? But other managers who may not be involved every day in the process as a freshening up of skills. So that sometimes requires some skill on my part in our building to overcome the "I did this last year, why should I do it again" conversation. But as one single board member, I would strongly encourage management to think about that coming from both ends.
Thank you, Mr. Shaver. Any other comments? Somebody'd like to make a motion? Oh, can we have a motion for this one?
Move approval.
Mr. Shafer and
I'll
Mr. Hunter, second. Call the roll, please.
Ms. Avila Frias?
Yes.
Mr. Schaefer?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Aye.
Mr. Hunter?
Yes?
Ms. Johnson Hall?
Yes.
Mr. Metcalf?
Aye.
Mr. Prince?
Yes.
Ms. Hoffman?
Yes.
Ms. Sotelo? Pardon me? Ms. Falk?
Yes.
Resolution 1725 is approved.
Thank you very much. Item number 6 are our reports. We generally don't go through these unless people have specific questions. Are there any questions on anything in item number 6? Okay. Item number 7 is other board matters. I have a question for Ms. Boatman-Patterson, which is with the fires in Northern California and also now in Southern California and the loss of so many homes. Is there anything that CalHFA can do to have programs for, in addition to what we currently have, to help fire victims?
Well, we are actually sitting on the, governor has a task force and a sub-housing task force that we've been working with on this, and I might turn this over to Ms. Hoffman if she wants to talk a little bit about that task force. But we have been working with HCD and sitting on that task force.
Great.
So the Housing Fire Task Force has been kind of split up into two parts. One is more immediate, and that's the emergency, a lot of work from HUD, and then there is the more long-term, and that's where CalHFA and HCD have been sitting, and Lynn from our office has been sitting on that task force. They meet once a week on Wednesdays for a couple hours in the governor's office to strategize, working with HUD as well on, what we can do in the long term. And I don't have any of the specific, things to report out right now that has been proposed, but I think we do have a lot of, great programs that we can help offer, and Tim, maybe you can,
Right. Now, some of CalHFA's limitations are the back end, like we don't do construction financing. And so working to with the small loan, SBA small loan program and FEMA and some of their programs, and then what are the things we could do on the back end. And I also understand that we've recently come across a disaster program that HCD ran a couple of years ago that we're looking at internally to figure out how do we bring that in. We're also talking to Fannie Mae. Fannie Mae, as you know, has a duty to serve manufactured housing, rural housing, and those folks making 80% AMI and below. And so Fannie Mae is really interested in perhaps coming in and doing some kind of a pilot program. And so we have been talking internally about some of those kind of things.
And one of the challenges here is that every county is going to be a little bit different. And now, of course, that those counties have expanded to include many more in Southern California. So we're going to be working with each county kind of individually to see what are their specific needs and what we can do to help.
Yes, Mr. Schaefer and then Mr. Metcalf.
The treasurer's office has no function in housing, but there is an important ingredient which we hope we're going to be able to be helpful with. The treasurer operates a program called the Time Deposit Program, where he deposits state money into local and community banks. And presently, that program has got about $5.4 billion in it. And recently, the treasurer announced and gave me and others in the building direction to redeploy as quickly as we can the existing deposits within that $5.5 billion to banks in affected communities, not for the purpose of making long-term mortgage loans, but to provide liquidity to banks in those communities so that temporary borrowing needs could be met more readily by community banks that are on the ground in those communities. And then supporting that action is a renewed effort on the part of our office to acquire insured portions of SBA 7A loans for small businesses that might be affected. So, those will not directly affect housing, but of course, if people can rebuild their businesses and gain access to liquidity for things, that will, we hope, promote, a healthier, a more rapid recovery rate.
Mr. Metcalf?
Yeah, if I may just mention a couple things that HCD is working on right now that I think would be of relevance to the board. The first is obviously working closely to try and figure out with HUD what we can be doing in partnership with the federal resources, and also continuing to work to advocate for additional federal resources. We have a few state funding sources that we are working to put out and make available to support in the wildfire recovery effort. So briefly, let me mention three. We have some recaptured CalHome funds, which can be granted to local governments and nonprofits for purposes of doing affordable home ownership in the amount of about $30 million that we'll be working to put out early in 2018 to the fire-affected counties. We also have about $30 million of mobile home park preservation and acquisition dollars that we are working to promote because there have been several mobile home parks that have been damaged or destroyed. And then lastly, we announced a couple weeks ago a new partnership with a national intermediary called the National Resource Network, which is going to be providing philanthropic match on a one-to-one basis with some of our CDBG funds to do capacity building and technical assistance within specific, smaller, economically challenged communities that have been impacted by the wildfires to help them come up with long-term strategies for the rebuilding work. And we'll be working to get more information out on that in the first quarter of 2018.
Thank you very much. Are there any other board matters?
Yes.
Ms. Boatman-Patterson?
Mr. Prince tried to steal my thunder, no. But we have some couple of key retirements that we're dealing with at the end of this year, and long-term employees and board members. And so Di Richardson isn't here to join us today because she is in Southern California, because as you know, she wears two hats. She's the Director of Legislation and the Director of the Keep Your Home California program. But Di is retiring at the end of the year after nearly 20 years of service with CalHFA and more than 35 years of service with the state of California. And so we want to thank her, even though she's not here, for her invaluable contribution to the agency, getting us through our ups and our downs of the legislative process and working with state and federal policymakers to make housing a priority and spearheading the Keep Your Home California program. Also, Mr. Freeberger, who is our acting board secretary for the past year, will be retiring at the end of the year after more than 18 years of state service, all with CalHFA. He is our longest tenured member of the Office of General Counsel. I see some of our counsel have come in to join us to thank Mr. Freeberg for his outstanding legal services to the state of California. We will miss his very dry wit, his deep legal knowledge, and his one-of-a-kind facial grooming that we wish him the absolute best in his retirement. And last but not least, our chair of the board is also retiring at the end of the year. This will be the last meeting chaired by Board Member Falk. And we'd like to take the opportunity to recognize her for her expertise in multifamily development, her thoughtful leadership and oversight that she has provided to this organization since 2012. Have you been on the board since 2012? 2012. She has led us through some very trying times, and her leadership and steady hand have been invaluable in making sure we have regained our sound financial footing and well prepared for whatever may lie ahead. She leaves us now to assist with something that is most important, enjoying her family and more specifically her granddaughter. Thank you, Janet, for your service to CalHFA in the state of California. CalHFA is actually a better organization because of these outstanding three individuals, and we want to thank you with our deepest gratitude. And we actually have a couple of little, my son calls them la la la. He's so funny. Mom, do you have any of the la la la, like little trinket wonderful things? But we have a wonderful clock, and Tom's clock, and we have a card for Tom. Time spent arguing is oddly enough almost never wasted, by Christopher. And we have a lovely clock with that inscription for Tom Freeberger. And for Janet, we have a lovely clock for Janet, which has on it, with sincere appreciation for your outstanding leadership, dedication, and support for affordable housing. We thank you both for your outstanding service and your leadership, both to CalHFA. Thank you. And at the close of the board meeting, I think we have a few little refreshments and some coffee that we can enjoy together at the close of the board meeting.
Thank you very much. Really appreciate it. It's been my great pleasure to serve on this board. When I first started, we had a lot of vacancies, so many of you who were not here by virtue of your office were not here. And now we have I think, a very strong board, and I'm really pleased that it exists in the way that it does. I believe Mr. Gunning, as vice chair, will serve as chair until the governor's office appoints someone else. So, okay. Is there any public testimony? If hearing none, then the meeting is adjourned.